macroeconomic numbers we got, as well as the global cues, which look very, very negative at this point. Chetan Ahya, co-head of global economics and chief Asia economist at Morgan Stanley, joins us on the phone line. Good morning, Chetan. Good to have you with us. A very happy Diwali to you. No fireworks for the market from the macroeconomic numbers. How disappointed are you with that inflation upturn higher than expected?
Well, it was only about 10 basis points higher than our expectations, Lata, so we're not really getting too worked up on this. Okay. We know that there has been some sequential rise in food inflation, which has been now reversed already in the month of November, partly, not completely. And as the crop output comes out, you should probably see pulses prices coming down, which has been the biggest bugbear for headline inflation. So I think from a big picture perspective, nothing really in the data at the margin that concerns us. I think the challenge really is for India is in terms of what's coming in from the rest of the world. And I know that we here in India always tend to focus a bit more domestic, but lately whatever is happening to the external demand, to the volatility in the capital flows, that matters more at the margin to our growth story.
Okay, well, Chetan, morning. Just wanted to ask you also about the IIP data, which is at a 4-month low at 3.6%, and more importantly, manufacturing growth has slowed down substantially this time. How much longer do you think we'll have to deal with low single-digit IIP?
Firstly, the IIP numbers are volatile, we know. Secondly is that I think the way we have seen the contraction in exports, and it's not just India, it's a regional thing, but India has definitely seen far bigger contraction in value terms compared to some of the Asian countries. We don't get the volume data for India, but when we look at the volume data for the rest of the region, for example, in Korea, volume of exports in October contracted by about 9%. So that's a deep fall in trade, which has been happening since some time. It started in March 2015, but has only gone one way. And that has been weighing big time on India's manufacturing too. So we think the exports problem or the external challenge from that is the one which is holding back. That then affects the capacity utilization, that then affects the private investment in manufacturing. So we've had this sort of negative feedback from the rest of the world, which is holding back our recovery right now.
That's right. Actually, even the Chinese loan data that we got in the last few hours indicates that China gave half the amount of loans, Chinese banks, in October compared to what they did in September, which was about 1 trillion yuan, falling to 500 trillion yuan. So basically, Chetan, my question is that global growth only looks getting weaker. How would that affect Indian markets? Are we going to see a serious risk of, from emerging market equities, a flight of money?
Well, equity markets is not my expertise, Lata, but I would say that yes, I mean, from the way the global data is at the margin, it's not showing any recovery, which is definitely going to be a challenge for our growth story. And one aspect is the real growth, as I mentioned, about the volumes of exports and then in turn it affecting industrial production. But the second is the impact of lowflation, which is this whole weakness in pricing power, not only just in commodities, but in non-commodities as well. When we look at the breakup of producers' price index in the region, non-commodities products are also in deflation. So that's weighing on the Indian corporate sector's top line and profitability. So if you look at some of the forces from the rest of the world that affects India, they don't seem to have clearly shown any big improvement. And as of now, we don't see any improvement in the numbers on a monthly basis. We expect that recovery to come through. But just have to be truthful to the fact that the actual numbers have not shown any improvement as yet.
Yeah, exactly. Globe is not helping, as you're saying. So when do you expect that cyclical upturn? Is it the current quarter? Is it next quarter? Every quarter we postpone it when we look at our corporate numbers. What's your own sense? I mean, IIP, if you look year to date, is still 4%, much better than what we had done in the same period last year. So do you expect an upturn in the second half itself?
In this calendar year, we don't have any big improvement in our global growth and emerging market growth trajectory. We have improvement from the second quarter of 2016. So if I take the aggregation of the feedback from our team, this is the period in which we see meaningful improvement. We don't see, of course, at the same time any big deterioration from here, but a meaningful improvement or the uptick will probably be visible from the second quarter of 2016.
Okay, and finally, December is going to be a very interesting month. On the 1st of December, we have the RBI policy, and on the 15th, we have the Fed policy. Given that we've had a front-loaded movement on rates, would you expect anything at all on the 1st of December from the RBI?
No, we are not expecting any change from RBI on 1st of December. We think they're front-loaded with the last 50 bips. And they would like to probably observe two things. One is what is happening to inflation, how sustained it is in terms of the low trend. And second is the reaction of the global capital markets or emerging markets to the Fed hike that it actually takes up in the middle of December.
All right, Chetan, we leave it at that. Thanks for joining us and giving us your view. So more